Hello to all investors and welcome back. In today's video we'll do a quick summary of What Works on Wall Street by James P. O'Shaughnessy. Please remember to buy the book and support the author for the full complete content if you like what you see. Our quick summary might do injustice to the authors and their complete value. This is why we always recommend our viewers to buy the book. Thank you. Now let us dive in. Did you know that a lot of investors fail because they can stick to one investment strategy? In the long run, they will lose to the S&P 500. 7 keys considerations to take before investing in a particular stock. 1. Market capitalization below 25 million is usually bad ideas. 2. Price to sale ratio is the most consistent ratio to buy a winning stock. This price to sale ratio is often called PS ratio. This ratio takes the market capitalization dividing total sales over a destinate period of time, usually 12 months. In this book, the author calls this ratio the king of the value factor. According to Mr. O'Shaughnessy, PS is the most reliable factor out of all the ratios. We would like to aim at the company that has 1.5 or lower when evaluating this ratio. From our point of view, please make sure that this company will still be around 10 years from now. Some companies with this ratio might not be around 10 years from now, and investors should be careful not to fall for this ratio trap or any other reliable ratios. 3. Buy with P ratio is the most profitable way when the investor truly knows the stock. 4. Last year's biggest losers are the among worst stock to buy. 5. Last year's biggest gain alone is the worst stock picking strategy. 6. Own large cap stock with a high shareholders yield. For those that don't know what high shareholder yield means, there are 3 ways that a company can distribute profits to its owners. Remember, when we buy stock from a company, we are part owner of the business. Therefore, when the business profit, it will be great if we can have some of that profit. There are 3 ways the company can hand us the profits earned. A. Give it out in terms of dividend. B. Buy back its own share. This way less share is available on the market, the stock price will increase. This approach is only morally right if the company has excess cash, and if the management truly believes that their stock is trading less than what they are worth out in the stock market exchange. C. Paying up their debts. With less debt, the less interest this company has to pay. Therefore, with this approach, the company will take in more profits next time around. 7. Relative strength is a good method to measure stock, but must add in many combinations to do it effectively.
Please, if you can do us a quick favor, may you kindly click like and subscribe if you like what you saw so far. This will be amazing. Doing so will really help us with the YouTube algorithm. Thank you so much for your like and subscription in advance.
Please remember, the successful investors are those that try to find a long-term strategy or group of strategies that have a history of winning and then stick with it. If we want to test our discipline, the author suggests that we buy the top 10 yielding stocks from the Dow Jones, and the best time to buy it is when a crisis hits. This strategy has worked for the last 75 years because it is not based on the emotion of the market, but truly test investors' sheer discipline to buy sounded companies when blood is on the street. So remember, when blood is on the street, have your top 10 list from the Dow Jones ready. In terms of dividend stocks, the author suggests that we should be careful with small stocks that give a high dividend. Trouble might be looming ahead. Some companies get in debt to continue dividend payment to maintain investor confidence. Such an approach is not only dangerous for investors, but for the companies themselves. Please also keep in mind that high risks do not always mean high reward. It is foolish to think this way because any fool can bet on the high-risk stock as I did. Before we move on to multiple factors like price-to-book value ratio and the number that you should aim for, please remember, if you do well in life, consider seeking ways to pay it forward to others. This message was brought to you by payingforward.net. Direct giving is what they believe in. Thank you. Description will be left below. Now let us move into multiple factors. 1. Price to book value ratio. Aim for 1.5 and below. 2. Dividend yield must be above the industry average, or greater than 2% a year. 3. Price to earnings or PE ratio must be below the overall industry average. And if you use the dividend to buy back the stock is a double return to your portfolio. Please keep in mind to ask your broker for this concept. Some brokers will not do it unless you ask them to use dividends to buy back the stock of the company that distributes you the dividend. I hope this helps you because when I first started I thought it is automatically that the broker will use my dividend to buy back more of the same stock. But that wasn't the case. So remember to ask your broker for this.
Overall, find what strategy works for you, keep doing it, and stick with it. Don't let the strategy out of the window if you know it works. We hope this video somewhat help you in your investment strategy. Please go to valuesnip.com for free intrinsic value calculators, and if you didn't like and subscribe, please help us out and do it now. You are amazing and thank you so much for your attention. We hope